Hello everyone, and welcome back to Dr. Tao's Quant Lab. In our last video, we used the PE ratio to find the absolute fair value range for a single stock. But what happens when you are staring at two competing companies in the same industry? And you need to decide which one is the better investment. To do that, we have to use relative valuation tools. Let's start with the PE ratio, which stands for price earning to growth. The standard PE ratio tells you how expensive a stock is, but it has a major blind spot. It does not tell you if the price is justified by the company's growth. A company with a massive PE of 50 might actually be a much better deal than a company with a PE of 15 if the first company is growing 10 times faster. To level the playing field, we calculate the PEG ratio by dividing the PE ratio by the company's expected earning growth rate, which we call G. Look at the definition box in your notes. G is simply the percentage increase in earnings. We find it by taking the new EPS minus the old EPS and dividing that by the old EPS. Just like the P ratio, the time frame matters. If you calculate G using historical earnings, you get the trailing PEG. However, because the stock market prices in future expectations, professional analysis primarily use estimated future data to calculate the forward PEG. I want to give you a very important math warning here. When you plug G into the PEG formula, you must enter it as the whole number, not a decimal. If the expected growth is 20%, you divide the P by 20, not 0.2. If you use a decimal, your math will be completely ruined. Now, unlike the standard PE ratio, PG is generally not used to determine the exact price bounds of a single stock. Instead, it is used horizontally to compare multiple stocks. There are three main rules of thumb. First, a lower PEG indicates higher investment value. It means the stock is cheaper related to its growth. Second, a PEG of exactly 1.0 traditionally implies the stock is perfectly priced for its growth. Third, if two stocks have the exact same PE ratio, the one with the higher growth rate will mathematically have a lower PEG, making it a better buy. Before we look at a real example, let's recall what we learned in section 1.7.2 about GAAP versus non-GAAP earnings. We prefer strict GAAP numbers for our historical baselines. However, when you look at forward estimates on Yahoo Finance or Moomoo, Wall Street almost universally uses adjusted non-GAAP numbers. Because non-GAAP removes expenses, the EPS is higher, which artificially lowers the PE and PEG ratios. There is nothing wrong with using non-GAAP for forward estimates, as long as you follow one strict rule. Never compare the GAAP PEG of one company against the non-GAAP PEG of another. Always compare apples to apples. Let's look at a real-world comparison using Moomoo snapshots from the market close on February 27, 2026. We are comparing NVIDIA and AMD. Retail investors often look at absolute share prices and assume AMD is the cheaper stock. But let's look at the math. If we divide the trailing PE by the forward PE, we can extract the implied one-year growth rate for both companies. For AMD, dividing 75.55 by 44.69 gives us an implied growth rate of about 69%. For NVIDIA, dividing 36.16 by 21.76 gives us a growth rate of about 66%. Now, let's find the PEG. AMD's forward PE of 44.69 divided by its 69% growth gives us a PEG of 0.65. NVIDIA's forward PE of 21.76 divided by 66% growth gives us a PEG of just 0.33. Even though there are similar growth rates, AMD's forward PE is double NVIDIA's. Because NVIDIA has a significantly lower PEG ratio, it actually offers much better growth at a reasonable price. Now, let's shift gears. P and PG are great for technology and consumer companies, but they are often useless for heavy asset industries like banks, real estate, or steel manufacturers, where profits fluctuate violently with economic cycles. For these companies, we evaluate their physical and financial assets using the price to book or PB ratio. The PB ratio divides the stock price by the book value per share, which is essentially the company's total assets minus its total liabilities divided by its share count. But does a low PB ratio automatically mean a bank is a great investment? Absolutely not. Assets are useless if management does not know how to make money with them. To see how well a company utilizes its assets, we must look at ROE, return on equity. As shown in your notes, ROE is net income divided by shareholders' equity, or simply EPS divided by book value per share. And just like we discussed earlier, your ROE changes depending on the time frame of the EPS you use. Using a historical EPS gives you a trailing ROE, while using an estimated EPS gives you a forward ROE. Let's look at our final example, comparing JPMorgan Chase, Bank of America, and Wells Fargo using their February 27th, 2026 snapshots. If a beginner look at the PB ratios on this table, they will immediately think Bank of America is the cheapest stock because it has the lowest PB at 1.289. JP Morgan looks wildly expensive with a PB of 2.365. But watch at what happens when we calculate the ROE by dividing the PB ratio by the PE ratio. Bank of America is generating an ROE of 9.85%. But look at JP Morgan. They are generating an incredible 15.76% return on equity. JPMorgan comments a premium price to book ratio because its management team is incredibly efficient. The market happily pays a higher premium for a bank that reliably maximizes the cash generated from its assets. To wrap up, relative valuation metrics like PEG and ROE are the ultimate filters. They prevent you from falling into value traps where a stock looks cheap on the surface, but it actually fundamentally weak underneath. In our next and final video for this chapter, we're going to combine everything we have learned into one master tool, the Quant Lab Valuation Matrix. I will see you there.